we have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts. Seems a bit remarkable to me.
The Fed needs to be now much more front-loading than before, so as to ensure that you are coming ahead of the curve, and I would not worry about overshooting with interest rates for a while to build up credibility.
I think the Fed has to be able to risk a recession.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's show. Jackson Hole in focus. Jay Powell will be under pressure to hit all the right notes in today's keynote speech as a hawkish chorus of Fed officials set the stage. Tech relief, progress in the dispute over Chinese listings in the US boosts stocks. Plus, no let up, the cost of the UK's winter triples as Ofgem raises its energy price cap to a record. Let's check in on these markets. Some of the early market optimism starting to wane now. A bit more of a holding position ahead of that important speech, of course, that crucial speech for many by Jay Powell later today out of Jackson Hole and Wyoming. Here in the UK, of course, still digesting that news. Not a big surprise, but still monumental in terms of the energy price increases. The cap being raised around £3,500 per household, a tripling there. Across your broader markets, futures stateside now pointing lower by 0.3%. And again, the gains that we've seen in Europe pairing somewhat. The expectations from many in these markets, you're going to get a more hawkish set of commentary from Jay Powell. They're going to push back on this idea from some of the markets that you're going to get a pivot in early 2023. In terms of euro dollar, just below parity still, not a lot of movement in the single currency. The 3-year or the 10-year, 3.07. You have seen yields ticking up, more pronounced towards the long end. So a move there of 5 basis points on the benchmark US 10-year, currently at 3.07. Brent currently $100 a barrel, gains of 1.4% for oil. You've seen upside in terms of basic resources and the energy space this morning. Continue to, of course, focus in on what's happening when it comes to natural gas prices as well. An emergency meeting from ministers in Europe to address what is happening in terms of those skyrocketing gas prices. The CAC going over in France, gains of 0.3%. You're seeing gains of about 0.5 here in the UK. The DAX in similar territory to the CAC, gains of 0.3% there. And Italy also at around that level as well. We're looking ahead to political risk as well, 1 month on ahead of those elections out of Italy, with a far-right coalition looking most likely as things stand. Let's get back then to the Fed. It is, of course, all things Jay Powell today. The annual Jackson Hole Symposium gets underway in Wyoming, and markets are bracing for a much-anticipated speech by the Fed Chair. For a bit of colour and context surrounding the symposium, Bloomberg's Michael McKee has more.
The Fed Chair's speech is the main event on Friday. Thursday, the talk of the conference was liquidity, but not the Wall Street kind. A massive storm hit Grand Teton National Park, flooding the roads and blowing down the TV tents, and creating its own inverted yield curve. Jay Powell's speech may not have an impact on the markets quite as dramatic, as investors have already priced in a hawkish message. Even if he says nothing new, they will probably take it that way. Meanwhile, we've had requests for a sequel to our history lesson on how the Federal Reserve ended up here. How did Grand Teton become a national park? A higher power took care of the mountains, scientists think about 2.2 billion years ago. Fast forward to 1929, and a small portion of this area became a national park. And then came John D. Rockefeller. He was so enchanted with the area, he basically bought almost all the land between here and the town of Jackson. And in 1943, he donated 43,000 acres to add to the national park. Now, this is where the deer and the antelope play. Grand Teton and Yellowstone to the north are also home to bison and elk. And once a year, in late August, you can spot central bankers in the wild here in Grand Teton. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
OK, the one and only, of course, Michael McKee of Bloomberg, giving us another history lesson from Wyoming, of course, throwing ahead to that important speech. We are joined now by April LaRusse, fixed income investment specialist at Insight Investment. April, thank you for joining us in the studio. What do you make of the market reaction and the market moves leading up to this speech by Jay Powell? What does it tell us about sentiment?
Well, everyone's hoping that they're actually going to say something meaningful about the pace and magnitude of interest rate rises. But frankly, we're not expecting you're going to see much. If you look back at 45 years of Jackson Hole, mostly it's been analysis. It hasn't been kind of big predictions or announcements. Clearly, last time Jackson Hole happened, it was all about transient inflation. This time, we think it's going to be about explaining why inflation is so hard to predict, where it's coming from, and thinking about ways to solve things like supply chain issues, labor market problems, et cetera.
So more of an academic deep dive in terms of inflation forecasting rather than a clear guide from Jay Powell in terms of where rates go from here. The market's still split on whether you get 50 or 75 in September. Some Fed officials, though, suggesting that we get to a point where we hike and hold. What is the market reaction to that scenario? Of course, it depends where we hike to.
Yeah.
Dot plots at 375 by the end of the year. If you hold at those kind of levels, what is the market reaction and fallout from that?
Well, the market's expecting interest rates to start going down by the second half of next year.
Are they wrong?
We think so, yes. I mean, there doesn't really seem to be a reason that inflation would be tackled so quickly, given inflation is so widespread. It's not just food and energy. Core is going up as well, wages are going up as well. So it's going to take a little bit longer to tackle inflation. There would be no real reason to do an about face so quickly. And in fact, there's lots of reasons to suggest that that could just allow inflation to rekindle, assuming that it had started to tail off before that point. So we think rates go up, maybe they go up a little higher than 375, and then they stay where they are for quite some time until the inflation dragon has been well and truly slayed.
There's all sorts of variables that go into this, but when you say quite some time, does that take us through 2023 in terms of having those elevated rates at a more persistent level?
Yes, absolutely. I mean, and obviously things can happen. Yeah. And should there be a massive change in something like economic growth, for example, or energy prices, probably more importantly, then of course things can change. And all the central banks are saying the same thing. They don't really want to do too much guidance. They'd rather be quite flexible because things keep changing. So they don't want to have to kind of backtrack. And it's important to just say, let's wait and see.
Is quantitative tightening, which is going to be stepped up, is that being underestimated by the markets?
Well, it's not being focused on at the moment for sure. And they have indicated that they'd like to shrink the balance sheets. So the question is, do they actually continue with that plan? Do they sort of, reduce the magnitude of the unwind? That we will have to wait and see. But we don't think you're going to get much conversation on that at the Jackson Hole symposium.
We still have the yield inversion, 2s, 10s, around 230 or something on the 2s, around 2.07, 3.07, I should say, on the 10-year. A bit of a movement in terms of yields, particularly at the long end today. Where do you want to be positioning across that yield curve, if at all?
Yeah, well, that is the million-dollar question, actually. I think really when we're looking at what the market is telling us about the yield curve, is it is telling us a recession is coming. Anyone can see that. Even central banks are kind of reluctantly admitting that a growth contraction is probably what's coming. In that sort of environment, maybe it isn't a big move in the yield curve overall, but actually perhaps you see all yields just shift a little bit higher as they come to realize that interest rates really do need to go up and stay up for longer than is priced in.
Okay. April, we'll get more of your analysis and more of your thoughts after the break. Thank you for coming to the studio. Of course, April LaRusse, fixed income investment specialist at Insights Investment, staying with us. Get more of our calls in the next couple of minutes. Coming up, a hawkish chorus of Fed officials, as we mentioned, set the stage for Jay Powell's hotly anticipated speech. We will bring you that speech live on Bloomberg TV later today. Do not miss it. 3 p.m. London time. This is Bloomberg. Welcome back. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Tom Mackenzie in London. Pressure is mounting on European leaders as energy prices continue to soar to levels last seen during the early weeks of Russia's invasion of Ukraine. Here in the UK, the average household will pay almost triple the price to heat their home this winter compared with a year ago. That's after the industry regulator Ofgem raised the energy price cap on the back of soaring gas prices. April LaRusse, fixed income investment specialist at Insight Investment, is still with us. April, how do you factor in this energy price crisis and shock? when you're looking at the fixed income space. To what extent is this priced in or not by markets?
Well, we all knew it was coming.
Yeah.
The problem we see is that at the moment we don't have a proper government, right? We're waiting for the new prime minister. The help that was offered to consumers, which was around £15 billion, is not sufficient. You probably need a whole nother package to come through. And if it is a trust government, it will take some time to get that organized. Clearly, the UK economy is in a big mess, so the new prime minister will have a very difficult job. In terms of how the gilt market is behaving, however, it's been interesting to see how very recently it's really markedly underperformed other markets. I think what's happened is financial markets seem to have woken up to the idea that the UK has the highest level of inflation of all the developed markets. It's got issues with insufficient labor, and I know a lot of countries are suffering from that, but the UK has an additional complexity of Brexit. So it is, and we still haven't ironed out our relationship with the EU.
Is this a basket case economy?
Well, let's not be too harsh, but it is. There are some things that need sorting, and we need a strong government to do it.
But to your point on yields have jumped, as you say, the sell-off in gilts, and yet the pound has not been supported. In fact, the pound's been going in the opposite direction. Does that point to a potential currency crisis?
I think the jury's out on that.
Okay.
We're not really expecting to see the pound struggle more than, say, the euro, for example.
Okay. Talk to us about the credit space and whether or not you see yields have come in a bit in terms of credit. Does that trend continue? And how much risk do you want to be taking within credit? Do you want to be staying in investment grade, or is it time to push out?
Yeah. Well, given the huge widening we've seen in spreads, it's hard not to look at that and think, there's some interesting value here. I think the issue is the markets are, of course, going to be looking into a winter where perhaps energy disruption and certainly more expensive energy is going to be an issue. We're going to have slowing economic growth. So, yeah, definitely credit is interesting now, but being quite cautious about where you're investing. Less cyclical sectors, for example, investment grade perhaps favoring over high yield. You still want to be a bit cautious, but there's absolutely value that's been created in the sell-off. So we are looking for opportunities.
Okay, so still value within investment grade, particularly. When it comes back to the sovereign space, and before we let you go, the politics of Italy back in focus, the countdown to that election. Do Italian spreads, do Italian yields, I should say, do they remain relatively well behaved, or is there a blowout potential? Have the ECB laid out a framework that's going to keep investors assured that there isn't going to be fragmentation?
Well, we've got a lot of tools in the toolbox. Yeah. We now have the TPI, and it will be utilized as long as whatever new government is formed in the next month actually looks like they want to behave in a fiscally responsible way and follow the European rules. And if that is what's being communicated by the new government, then of course the TPI will be utilized, and the other ways of keeping spreads at a sensible level. Italy has the potential to see further widening from here, but there are certainly ways to contain that as long as the comments from the new government are towing the European line.
Yeah, Maloney, who is the likely, possibly as the polls suggest, the likely Prime Minister, saying they will be a fiscally responsible government, but of course we'll have to watch to see what actually happens if indeed she does take power with that coalition and what the implementation looks like. Thank you very much indeed. April LaRusse, the views there on the sovereign and the broader, the corporate credit space as well. April LaRusse, fixed income investment specialist at Insight Investment. Thank you. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Good morning, Tom. President Vladimir Putin has ordered the Russian military to increase its armed forces by 137,000, or more than 10%. The decree did not explain whether that would happen with a draft or by upping the number of volunteer soldiers, or actually both. So far, the Kremlin has avoided a mass mobilization as it seeks to limit the domestic fallout from the war with Ukraine. White House Chief Medical Advisor Anthony Fauci says he expected the U.S. would have moved past COVID after the first year of the Biden administration, but the disruption from the virus has lingered longer than he actually anticipated. The infectious disease expert has been speaking days after announcing he's stepping down at the age of 81.
I thought after yet again another year, we would have COVID behind us. But as it turns out, that's not the case. We've just got to get more people vaccinated and more people boosted. That I think we're really on the threshold of getting COVID to the point where it is at a level where it is low enough that we can actually not have it disrupt the social order.
Meanwhile, global monkeypox cases have declined for the first time in a month, led by a drop in infections across Europe. The WHO says new cases fell 21% overall in the last week, but continue to rise in the Americas. 6 countries have not reported new infections for more than 3 weeks now, the maximum incubation period for the disease. And Novak Djokovic has confirmed he'll not play in the US Open, the year's 4th and final Grand Slam event. The tennis star's participation has been hit by the America's vaccination requirement for international travellers. One of the few remaining COVID-era rules in the country, Djokovic's anti-vaccine stance did become a real flashpoint after he was removed from Australia back in January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you. Coming up, UK household energy bills are set to soar as the regulator announces a massive rise in the price cap. We've got more on that story next. This is Bloomberg. Welcome back. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, the average UK household will pay almost triple the price to heat their home this winter compared with a year ago. That is after the industry regulator, Ofgem, raised the energy price cap on the back of soaring gas prices. Let's bring in Bloomberg's Todd Gillespie then to walk us through this announcement and the implications. Not a big surprise. It's still huge, but we knew, looking at the methodology, that the levels were going to be raised around this amount. What does it tell us about price pressures across households and where prices go from here, Todd?
Yeah, absolutely. I mean, the methodology for this is quite transparent, but that also makes it scarier in a way because you can see down the tracks that this is going to get even worse. I mean, we've had the first estimate today that came out for April price cap from one consultancy predicts that it's going to rise above £7,000. So that's double winter in April.
So that's April, £7,000. We're at 3,549 and change now, up to 7,000 by April.
Potentially, yes, and about 5,500 in January based on current market prices. The issue is that it's hard to predict what level this is going to be because there's an observation window that is based on market prices that are very volatile, and that window only opens the closer you get to the price cap.
So what are the options for the government at this point?
I mean, there are lots of options. There are fairly few that have been actually put on the table so far because we are, having essentially a postponing of big policy before the new Prime Minister is announced on the September the 5th. So, I mean, there's a wide range of things from nationalising energy suppliers to freezing bills entirely, like they've done in the Isle of Man, which is slightly separate to Westminster policy making. It would cost at least £29 billion, at least to do it in the short term. If you're looking further ahead, suppliers, some of them have been calling for a £100 billion package to help smooth and stabilise prices over the next 2 years, on top of further benefits, household support for the lowest incomes. One supplier this morning has basically been saying we should quadruple the support for the poorest households, which is known as the warm home discount. But there are all these different policy options. Most of them do involve handouts. Most of them do involve a lot of money. But also, these things could help smooth out inflation as well when we, look ahead to sort of delaying the shocks that would come to the economy. Depends, how you want to divvy that up and where you want that to come.
We cannot get to £7,000 per household. For so many households across the country, that would be more than their mortgage payments. Absolutely. It would be totally unsustainable. What about businesses? Before we let you go, Todd, in terms of the business impact, businesses not protected by this price cap.
Absolutely, yeah. I spoke to one business earlier this week who's had a 9-fold increase in their bill. Other ones that have shut down entirely. So we're seeing, small takeaways, pubs, all the way up to big manufacturers, all, really feel the pressure from this. And Bloomberg's reported also this week that the government's well aware of the risks of this. Well more than a year ago. And the planning for this is essentially now coming down to, thinking about what we can shut down without damaging the economy too much. So it really is a case of damage limitation at this point, because there is no cap right now for businesses at all. They are fully exposed to this volatility of the wholesale
Great stuff.
market.
Thank you, Todd. Todd Gillespie walking us through what's happening in the energy space, particularly here in the UK for households and businesses. There are possible tools at the disposal of the government. It's the ones that they reach for, but there will be a cost as well. Coming up, a hawkish chorus of Fed officials set the stage for Jay Powell's hotly anticipated speech. Later, we bring you that speech live on Bloomberg TV. This is Bloomberg. Jackson Hole in focus. Jay Powell will be under pressure to hit all the right notes in today's keynote speech as a hawkish chorus of Fed officials set the stage. Tech relief, progress in the dispute over Chinese listings in the US boosts stocks in Asia. European stocks and US futures fluctuate ahead of Jackson Hole. Plus, no let up. The cost of the UK's winter triples as Ofgem raises its energy price cap to a record. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Looking ahead, of course, that focus on the speech from Jay Powell later today. Bloomberg TV also spoke to the host of the symposium, of course, in Wyoming, Kansas City, Fed President Esther George. She says the Fed may have to take interest rates above 4% for a time. They're currently around 2.3%, as current rates are not weighing on the economy.
The chairman will deliver the opening remarks. I haven't previewed his remarks, so I can't tell you what's in there, but I will just tell you from my own perspective, Kathleen, it's very important that we are clear in our communication about the destination we're headed. And I think that destination is important, which is we have to get interest rates higher to slow down demand and bring inflation back to our target over some period of time here.
So let me ask you, Esther George, in particular then, are you willing to keep hiking rates if you see unemployment rising, if you see the economy slipping towards what could be a recession, even into recession? Are you willing to stay on that path if inflation is still too high?
So I think we have to, by mandate, bring that inflation rate down. And right now, the unemployment rate is running below, I think, what most people believe is a natural rate of unemployment. So the labor market is too tight. And by bringing demand down, we should begin to see the labor market loosen up a bit. I think we're already seeing some early signs of some of that consumption, some of that demand leveling off. But certainly you are not seeing it fully in the inflation data yet. It is still very broad-based, and I think tells us there's more work to do.
Well, the general consensus among you and your colleagues seems to be you raise rates to a restrictive level and you leave them there for a while rather than start to bring them back down again. So what's your level, and how long do you think that they would have to stay there?
So I think knowing the exact level, knowing the exact number is really going to be a process. I couldn't tell you today where we are today is not restrictive, I would argue, yet. We still have high inflation. So I think it tells us we have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts, seems a bit remarkable to me. I think we will have to hold.
Over 4%?
It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
You've been doing this for a long time. The old adage was, don't fight the Fed. Why do you think the markets are fighting the Fed now and not listening to what you've been saying about how serious you are about taking on inflation?
I don't know what drives the markets, Mike. I probably would not be well positioned to say that. Certainly it is important for our communications to be clear because we want financial conditions to tighten along with the direction we are moving around policy. So I think it puts a premium on being clear in our communication, of having resolve toward the end game here. And again, the end game is to bring inflation back to our 2% target. And that's challenging in the environment we're in. We're coming off an unprecedented period. The economy, I think, in some respects, is still sorting itself out. We have global factors to take into that. So there's a lot to think about. I'm sure markets are thinking about that even as we proceed with this interest rate increase cycle.
Kansas Fed President Esther George there. We're joined now by Thomas Costerg, Senior US Economist at Pictet Wealth Management. Thomas, thank you for joining us. What are you expecting then from the speech from Jay Powell? Is it going to be a nothing burger or a slapdown for the markets?
Right. So actually 2 points. One is that the Fed started to pay more attention to growth data at the July meeting. So they were taking more into account the growth picture and not just inflation. I would expect that to actually continue. I think we should not expect a pivot. It's still too early, but I think the Fed at the margin will pay more attention to growth data. Point number two is the reaction function of the Fed should also change. I think they'll take more into account the leading indicators and not just the backward-looking data. And they will, I think, pay more attention to the recession risks. So in the end, I would expect Jerome Powell to indicate that they could modulate and probably diminish the pace of rate hikes in the coming weeks and potentially as soon as the September meeting. But again, I think for a true pivot to happen, I think we're still, it will be down the line and we're not yet, I think they're not yet ready for a full pivot.
Okay, very interesting, Thomas. That sounds like something that would be interpreted as a dovish signal by the markets.
Well, I think the market has built, some very hawkish expectations going into this Jackson Hole meeting. It is true that most regional Fed presidents that we've heard in August were on the hawkish side. They've insisted on the fact that inflation is still high. But again, I think inflation has probably peaked in the U.S., which is not the case in Europe, but at least in the U.S., it's the case, I think. And point number two is that the data is going to deteriorate, so there's less demand in the economy, and that should also bring down inflation down the line. So, the recession risks are quite high. And I do think that, Jerome Powell is also listening to that, in contrast to some other, regional Fed presidents who are more focused on the backward-looking inflation data.
We have Esther George. We heard from her just a couple of seconds ago saying that maybe you might have to get to 4% and hold it around that level. What for you is the terminal rate then, given what you've been saying about that additional focus on the economics and the slowdown in the economy? And where do you think that leaves the dollar?
Right. So I do think it will depend on the job market in the end. The job market has been quite resilient, and as long as that's the case, the Fed could continue to hike interest rates. Though I would expect, the labor market to come under some pressure. Most other economic indicators have been softening lately. Obviously the pain right now is in the housing market, but I think it will eventually come and catch up with the labor market. So I would expect the labor market to start really to soften by the end of the year. And I would expect the Fed to stop potentially the rate hikes by then. So I would be probably on the lower side versus current market expectations.
That's interesting. So the labour market's starting to catch up with what's happening in housing, maybe a softening of the labour market by the end of this year. Thomas, talking of the housing market, mortgage rates on the 30-year back up above and around 5.5%. And we've seen on a number of fronts a slowdown across the housing market in the US, as you mentioned. Is it still the canary in the coal mine for the US economy?
Well, I would tend to think so. Housing is only 5% of GDP when you look at the residential investment share of GDP. But there are some spillover effects into the rest of the economy. And so I'm a bit surprised that the Fed is not paying more attention to the housing market. I mean, the data is actually quite weak. New home sales were down almost 30% year on year in July. I mean, that's quite a big drop. And I think soon you will see, home prices starting to soften as well and potentially go into, go negative year on year, based on the correlation with rising housing inventories. So, yeah, I think the housing sector is still the canary in the coal mine. I think that will be the main reason why the U.S. goes into recession. However, it should be a mild recession because there are no, we don't have the same imbalances in the economy that we got during the subprime crisis. I think that's the silver lining here. But still, I think the downturn in the housing market could be strong enough to push the U.S. into a mild recession.
OK, and talk to us about the linkages between the housing market and the health of the all-important US consumer. At the front end of this year, a lot of our guests were saying, look, the balance sheets of households in the US are very solid. How much fragility is there now amongst the US consumer, particularly as these house prices come off?
Right, and yeah, you have two views in the market about the health of the U.S. consumer. One is that balance sheets are strong, but there are still some details showing that there's a massive increase in leverage, and especially about consumer credit is coming back and quite very fast. And that may suggest that actually for some consumers that they've already run out of savings, and we may be close to the end of the runway in terms of their purchasing power, especially as inflation is high. So I'm a bit more worried about the U.S. consumer than most. And I would like to see a bit more spending coming from incomes rather than from credit. But I do not think that the consumer is really the problem. I do think that what I watch the most right now is the housing market, inventories as well, and business capex.
Okay, the importance of the housing market. Thomas, before we let you go, 50 or 75 in September then?
So we're in the 50 camp, but that will depend on payrolls as well as on the ISM index as well. I think the ISM could gain more importance in the Fed's reaction function. I would expect the ISM to be in contraction, but we shall see.
Okay. Excellent insights. Thank you. Thomas Costerg, Senior US Economist at Pictet.
Thank you very much.
Wealth Management, joining us from Geneva. Have a great weekend. Coming up, Italians go to the polls in a month. We will discuss who may replace Mario Draghi next. This is Bloomberg.
It's a long list, but the Fed has to focus on inflation and has to do it in a more committed fashion than it's done it so far.
So it's been trying to sound, Mohammed, committed, right? I mean, they've basically been saying inflation is their number one issue that they're facing. Why is the market not hearing it?
Two reasons, Lisa. One is the Fed itself. Let's not forget that Chair Powell stated that we were at the neutral rate. The minute the market heard that, it moved, and it moved in a significant fashion, and all the talk about pivot started being amplified. So that's one reason that the communication hasn't been consistent, and that's been a problem for the last year. And the second issue is that the market is looking at the impact on growth, is looking at the potential impact on markets, and as John said earlier today, remembers the fourth quarter of 2018, remembers the Fed blinking, so it believes when push comes to shove, the Fed is going to blink again, that we're going to have a flip-flopping Fed.
Mohammed, what I hear from you is that you don't think this Fed blinks anytime soon.
I don't know, John. I know what they should do, which is they should not blink. But it's been very difficult to call this Fed. This Fed has unfortunately failed at analysis, failed at forecast, failed at communication. So it's very difficult to say what this Fed is going to do. It's easier to say what it should do, but it's much harder to say what it's going to do. And that's why you get this disconnect that you've been talking about between the markets and the Fed.
So let's go there and wrap up this segment with you on what you think. Larry Summers called that neutral comment analytically indefensible. You said on neutral, and I think you were a little bit more diplomatic about it when we last spoke, you said the zip code for neutral was higher than where we are right now. Mohammed, what is the zip code for neutral, and how on earth do we know with inflation where it is and where rates where they are right now?
So I don't know specifically where it is, and I've been warning against spurious precision. There are so many structural changes going on. We are changing liquidity regimes. I said earlier, we're going from a world of deficient aggregate demand to a world of deficient aggregate supply. That's the world we live in now. No one knows for sure where neutral is. So you've got to try to figure out as you go along the way. And you mustn't attempt this spurious precision, because if you do, the market is going to jump immediately to conclusions, and then you're going to have to undo it. You know, the Fed itself, Fed officials have walked back that comment. It didn't take many days.
Okay, Bloomberg opinion columnist Mohammed El-Erian there saying the Fed should not blink when addressing inflation. Let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Hi, Tom. The UK regulator has lifted the cap on energy, gas and electricity bills to £3,459 a year from October. Liz Truss, the frontrunner to become Prime Minister, is reported to be planning more help on energy costs within days of taking office. European Energy, meanwhile, has extended its rally, adding pressure on the region's politicians to do more. In France, the cost of power hit a new record after EDF said more of its nuclear reactors will take longer to come back online after stoppages. Now, OpenText Corporation of Canada has struck a deal to buy UK software firm Microfocus International for about $6 billion, including debt. The offer comes at a 99% premium to yesterday's closing price and builds on the Canadian firm's strategy of growth by acquisition. Microfocus sells enterprise software to businesses including Airbus, Hewlett-Packard and Kellogg. Twitter has been ordered to hand over more information about spam and bot accounts to Elon Musk. The judge has ruled it must turn over information about 9,000 accounts it surveyed last year. Twitter had sought to deny Musk access to this historical snapshot on privacy and other grounds. LastPass, a password manager used by more than 33 million people around the world, says a hacker recently stole source code and other information, but the company says it doesn't believe any passwords were taken as part of the breach. And that's your Bloomberg Business Flash. Tom.
Leanne, thank you very much indeed. OK, it is just under 1 month until Italy holds a snap election. It comes after a unity government led by Prime Minister Mario Draghi collapsed last month. To get a preview then on the upcoming vote, let's bring in Bloomberg's Alessandro Speciale in Rome. Alessandro, what is the polling data then telling us about this election and who the frontrunners are?
It's a very clear, it seems right now that the outcome was very clear. The only question is whether the right-wing coalition led by Giorgia Maloney will score a big victory or whether the coalition will score a huge victory. Some polls even put her within reaching distance of having a two-thirds majority in parliament, which would allow the right-wing coalition to change the constitution on its own without needing external votes. This is a very clear situation, and this is also one of the reasons that Draghi's government failed. The opportunity was too good to go to early election and capitalize on this very good moment with the electorate for the right wing.
So big or huge, it sounds like Maloney is almost crossing the line on this victory. We'll see. We're a month away. What are the main themes dominating the campaign then, Alessandro?
Well, of course, energy is one of the key themes. The left-wing, center-left coalition led by Enrico Letta is trying to revive its electoral fortunes by proposing price controls for energy for the next 12 months, something that Maloney is opposing. Then, of course, there is immigration, one of the strong themes of the right, and then there is what to do with the almost 200 billion euros that Italy is set to receive from the EU. This money is dependent on a program of reforms that Draghi was working really hard to implement, but now Maloney has said that she wants to renegotiate the plan, which could take months, and of course, if some milestones are not met, the disbursements to Italy could be stopped.
Yeah, indeed. And of course, they've come out and said, Maloney and her team have said that they will be fiscally responsible. But of course, any commentary on that and how they react is going to be important, isn't it, for the EU? Talk to us then about Giorgia Maloney, who she is, her complicated biography. There's the historical links, of course, uncomfortable, painful links to fascism in Italy. How close is she to that history?
Yes. Maloney, 45, has been a professional politician for more than 20 years. She's done all her life in politics. And as you were saying, she started in the youth movement of Italy post-fascist party. So her party, the party she leads now, Brothers of Italy, is a far-right party. Of course, they say they have cut ties with their fascist past, and this was many decades away, but of course this shadow remains. But there is another interesting factor that also contributes to explain Maloney's current popularity. She is, so to speak, the last woman standing. In the current term of parliament, her party is the only one that hasn't been in power, that hasn't been in government. We had 3 governments in the term of the current parliament, and Maloney's ability has been to stay away from being in a position of powerful all her career. She was only a junior minister for 3 years at the beginning of her career. Ever since she's been a political operator, she's been in parliament, she's been in parties, but she hasn't taken any policy-making decisions. And this is the most interesting thing about her. She will have to take decisions if she becomes, and she wants, prime minister.
Very, very interesting realignment of the Italian political picture, just broken down brilliantly by Alessandro Speciale in Rome. Thank you for that update a month away from that vote. Coming up, workplaces demands and the demands around workplaces, they are changing as younger generations enter the global workforce. We're going to look at how employee priorities are evolving, the implications for the economy. That is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Happy Friday. Now, how do Generation Z's or Z's workplace demands differ from those of today's staff? Bloomberg's Laura Wright has a deep dive into the future of work. Laura, how do younger workers then, how do their attitudes differ? How have they changed from their ageing, greying colleagues like myself?
No, don't say that, Tom. Well, basically, the Centre for Economic and Business Research conducted a survey with UK employees on what aspects of their job they value the most. We can assume these trends can be extrapolated in other developed markets. And basically, a good work-life balance, job security, a respectful atmosphere, and salary are the top considerations. Now, notably, a good work-life balance has increased more than 30 percentage points from respondents over the last 10 years. And similarly, a respectful atmosphere has seen an increase of more than 20 percentage points. Salary, while it's fallen down the leaderboard, it's likely to move up given recent concerns surrounding cost of living. And they've also looked into what factors are likely to see the greatest increase in importance for Generation Z in the next 10 years. It's things like more flexibility, the option to work from home, and this aligns with recent research that office occupancy rates in the developed world have peaked at 40 to 50% after the pandemic. There's less appetite to be in the office 5 days a week. Now, environmental concerns are no longer a peripheral focus. Employees want to see concrete action, management opportunities, and business equity, essentially taking more ownership of your career earlier on.
OK, Laura, right there on the changing demands around the future of the workspace from Generation Z or Z. Thank you. Checking on the markets before we let you go. Bloomberg Surveillance, of course, early edition continues next. Currently, European markets down 0.1%, a holding position really ahead of that all-important speech from Jay Powell. Kriti Gupta, Kailey Leinz and Anna Edwards here in London bringing you the latest next. Stay with us. This is Bloomberg.
The Fed has been asleep at the wheel, and that's unfortunate.
I think the Fed solution, and I happen to agree with it, is slow the economy down.
I do think the Fed is going to push back on all this chatter about pivots.
I think Chair Powell needs to do a bit better in expressing some candor about the past, not necessarily mea culpa, but for what happened, and about the future.
It's very important that we are clear in our communication about the destination we're headed.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Countdown to Powell. The Fed chair will be under pressure to hit all the right notes in today's Jackson Hole speech, as some of his colleagues stress the need to move onwards and upwards with rates. UK regulator Ofgem triples the price of winter for many households with a hike in the domestic price cap, whilst warning more hikes will come. And President Biden shifts into campaign mode. The US president touts a string of legislative wins and urges voters at a rally in Maryland to protect those policies. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz over in New York this Friday. Matt Miller is off today. And Kailey, we've had some pretty hawkish warm-up acts to Jay Powell.
We have, Anna. What's interesting, though, is that it didn't really weigh on risk sentiment in the U.S. yesterday, and it didn't really in Asia overnight either. In fact, fact, most stocks were higher. The MSCI Asia Pacific Index rallying by just a few tenths of 1%, about 0.4% or so. But some of the outperformance came specifically from big Chinese tech stocks and other Chinese tech stocks that also have listings here in the U.S. after a report yesterday that the U.S. and China are getting closer to an agreement on those auditing rules that potentially could prevent those stocks from having to delist from U.S. exchanges. So that led to a big boost in some of those shares, including GDS. Of course, the ADRs of GDS in the U.S. yesterday rose about 8%, and in the Asian session, they were up more than 5%. Of course, the other story in China we continue to follow is the stimulus to support the economy and specifically the property sector. And you're seeing some feed through to that in the commodities market, specifically iron ore, up about 3.5% in Singapore overnight. 106.75 a ton is where we trade. And finally, it is a stronger dollar story ahead of Chairman Powell's speech later today, Creedy, against pretty much everything in Asia, including the Japanese yen, weakening against the dollar to just shy of that 137 level.
And that stronger dollar story may certainly be playing a little bit of a role when it comes to the cross-asset picture. Take a look at the S&P 500 futures. They are down about 0.3%. No real selling conviction here, but still it makes sense that just seeing a little bit of a pullback in the equity market after, by the way, we got a 1.4% gain in the S&P 500 in yesterday's session. So once again, those technicals really coming into play here. The 10-year yield, by the way, higher nonetheless, up about 4 basis points. Once again, perhaps reversing some of the massive moves we saw yesterday as well. You also mentioned the dollar index. Compared to other currencies, you are seeing some pretty big moves. When you look at the composite, the Bloomberg dollar index as a whole, well, it is kind of unchanged. So really looking to the specific currency pairs for that kind of move and for the ripple effect there. And speaking of ripple effects, Bitcoin down to the tune about 1%. Is that some sort of crystal ball for what we're going to see in the stock market? I guess we're going to find out shortly, Anna.
Yeah, absolutely. The European map then, Chrissy, is a picture of, well, either an August trading day or the fact that we're waiting for something. And in this case, it's both. It is August and we're waiting for the Jackson Hole speech. As a result, we're pretty flat across the European equity markets. Quite a lot of grey on the map for you this Friday. Let's have a look at some of the commodities and some of the stock-specific stories that we're covering. I don't want to just talk about gas prices when they go higher. Also think it's important to mention when they come down. This is the natural gas price, still at incredibly elevated levels on that European benchmark, but it is coming down by 5.7%. It's been lower than this. It's been below 300 euros per megawatt hour a little bit earlier on in the session, but now down by around 6%. Relex PLC, this is a UK-listed publishing business, but its US business is in focus with analysts. They are saying that some of the change in rules around open source for federally funded research, that's going to limit the amount of money they're able to make on some of those research publications. And as a result, that stock and others in that sector are weaker. In fact, media is the weakest sector for European equity markets today. That could be something to watch over in the United States in the US session as well. Sanofi is up by 2.4%. The drug maker over in France, I could have put in here GSK or Haleon, both of those drug makers in the UK also rising on the same story. A tentative ruling from a judge in Florida has has investors asking themselves what kind of settlements might be needed to be paid to those who claim that their cancers are caused by antacids, which are made by those three businesses. And as a result, we're seeing some speculation that those payments will be reduced, and we are seeing those share prices move higher. Microfocus, this is a software company based in the UK. FTSE 250 listed, Kailey, and we see it up by 92%. A Canadian company has made an offer for that business.
Yet a 92% move looks almost meme stocky, Anna, but I guess it does have something to do with the fundamentals. Speaking of the fundamentals, let's take a quick look at what is ahead today. We'll be getting some key U.S. economic data with personal income, PCE deflator, and the all-important University of Michigan consumer sentiment on deck this morning. But as we know, it is really all about Chairman Powell. He will be speaking at Jackson Hole at 10 a.m. New York time, 3 p.m. in London. We'll be bringing you live coverage of that speech, analysis, and market reaction. So buckle up, Creedy.
Absolutely. I think we all are. We have been all week long. Well, Bloomberg spoke to the host of the Jackson Hole Symposium, Kansas City Fed President Esther George, yesterday. She's among the Fed officials signaling interest rates will need to keep going up to fight inflation.
We have more room to go. That we would bring those rates down quickly, and I've seen that in some of the forecasts, seems a bit remarkable to me. I think we will have to hold.
Over 4%?
It could be over 4%. I don't think that's out of the question. But again, you won't know that, I think, until you begin to watch the data signs.
Joining us now is Bloomberg Markets editor Christine Aquino. Christine, the markets are going into this Jackson Hole meeting with some very hawkish expectations. What could the reaction look like?
Well, Critty, I think it really, again, depends on what Jay Powell says. And, I think what markets are looking for at this point in time is really specificity over the magnitude and the extent of rate hikes that we're still going to be seeing from the Fed. Remember, they've already delivered more than 200 basis points of rate hikes this year alone. But, of course, there's expectation for a lot more, especially given pricing for where that terminal rate is going to be. Now, the problem is this, right? It sounds like a lot of the Fed officials that have spoken ahead of Jay Powell really have not been able to indicate any specific level. And we understand it is very, very difficult, of course. I think, the Fed is still very much data dependent at this point. But, this is kind of the gap between markets and policymakers, right? Markets really want that specific indication, at least, of where and how high rates are going to go. But I just don't know that Fed officials, Powell even, will be able to deliver that.
Right, yeah. Will he have anything concrete to add on that if they are being quite so data dependent? What about this debate around the terminal rate then, Christine, and how high it gets and how long it stays there for?
Yeah, absolutely, Anna. I mean, that really is very much the focal point at this point, right? I think this is what policymakers and markets can agree on, is that the terminal rate is potentially going to settle around 4% or perhaps slightly higher, just given where we are at now. And, it hasn't been too long ago when that level was a whole percentage point lower at 3%. But this is how far we've come in terms of just the inflation levels that we've seen over the last couple of months. And so, yeah, I think there is very much the expectation that there is potential for that to get even higher and perhaps even overshoot. Again, it just depends on where it settles exactly. And yeah, again, the question is how long it's going to stay there for before they're going to have to start cutting.
All right, Bloomberg's Christine Aquino, thank you so much. And of course, we'll bring you live coverage of Powell's speech in Jackson Hole. That's at 10 a.m. New York time, 3 p.m. in London. Meanwhile, the average UK household will pay almost triple the price to heat their home this winter compared with a year ago. That's after the industry regulator Ofgem raised the energy cap on the back of soaring gas prices. I spoke with Utilitas CEO Bill Bullen yesterday about those rising energy costs.
Obviously, we go into the summer in the UK. Summer demand is much lower than in winter. Customers were going to really struggle going into this winter, but the idea of them going up to this new level of £3,500 just as winter demand is starting to pick up is absolutely horrendous.
Bloomberg energy reporter Todd Gillespie joins us now with more. Todd, what's the scale of this rise and how horrendous, as how he put it, could it get?
Yeah, I mean, I think it's something that's really unprecedented right now. We're essentially seeing a 178% increase based on the price that households would have paid last winter. Some people are talking about this as an 80% hike on April's rate. That really understates the issue because you have consumption that rises massively when households need to heat their homes during the winter. But the key thing that we're really looking at now, I mean, this estimate was priced in already into the way that people are thinking about inflation, the way that people are thinking about markets. But looking down the tracks, we're seeing another hike in January. We're going to see another hike in April. And both of those are going to be even higher based on current market prices than the one that we're going to see in October. The first estimate out this morning to surpass £7,000 in April came from consultancy Auxilione. So this is really something that is unsustainable for the UK economy without government help.
Right, and if it is unsustainable then, Todd, what could the government do? We are in the midst of a leadership contest, so the Conservative Party trying to find a new leader and therefore a new Prime Minister for the country.
Yeah, I mean, the Conservative Party is really kind of, some people are saying they're putting a bit of a spanner in the works in terms of putting in place emergency help right now because no new big policy decisions can be made until September the 5th when we're expecting a new Prime Minister to be installed. Liz Truss has said this morning that, she is aware of the scale of this problem. The Chancellor at the moment is saying that they're working flat out to, prepare options for people. But realistically, whatever it takes, we're going to be seeing anything from freezing bills, which the Labour Party is proposing, a lot of the opposition parties are proposing, which is going to cost in the tens of billions of pounds, to further handouts for households. More suppliers are calling for a £100 billion deficit fund, which could help spread prices over the next couple of years. All of these options will cost the government a lot of money. But then again, you also are talking about how we're going to smooth inflation potentially, because this shock that's coming in October is going to be one of the biggest sudden shocks to household expenditure that the UK has really ever had in recent history.
All right, Todd Gillespie, thank you so much. Now, from political issues in the UK to politics here in the U.S., President Biden kicked off his midterm campaign effort yesterday with a rally in suburban Maryland, testing his message ahead of what White House aides say will be an active 2 months of touting achievements and aiding Democratic candidates.
So I want to be crystal clear about what's on the ballot this year. Your right to choose is on the ballot this year. The Social Security you paid for from the time you had a job is on the ballot. The safety of your kids from gun violence is on the ballot. And it's not hyperbole, the very survival of our planet is on the ballot.
Emily Wilkins, Bloomberg government reporter, joins us now with more from D.C. Emily, how is this message resonating with voters? Is there a sense that the Democratic tide is shifting a bit as we get closer to November?
Kailey, there is a sense in D.C. that the tide is shifting. Remember, the projections at this point are that these midterms are going to be great for Republicans. They have historical precedent, they have redistricting, they have the high inflation that they can really go ahead and criticize Democrats for. But at this point, Democrats are actually starting to feel better. They're seeing inflation level off. They're seeing gas prices come down. They were able to pass their major initiatives through Congress. And they had a really key victory in a special election in New York this year. So really, Democrats are feeling very good right now. President Biden is feeling very good right now. He still is having trouble with his approval ratings. They're currently at about 41%, according to an aggregate of polls compiled by 538. That is slightly up from where he was in July, but that's not particularly high right now. And it could really impact a lot of candidates down the ballot as far as how folks see Democrats at a national level. You've already seen a number of Democratic candidates begin to really distance themselves from President Biden, and he even joked last night that, he would either campaign for or against senators, depending on what would help them the most. So you see that confidence, but at the same point, it'll be very interesting to see how this plays into the races for the House and for the Senate.
Well, Emily, let's talk about the other side of the aisle, specifically President Trump as he deals with the warrant and the affidavit dealing with the search of his Mar-a-Lago home. What is the latest on those developments?
So yesterday, we did hear a federal judge say that certain parts of that affidavit could be made public. The Justice Department did request some redactions. They want to protect their current investigation, witnesses involved in that investigation. But we are expecting them to release that redacted affidavit at noon today. This has been a huge, explosive story, particularly in Trump world and among Republicans. There are lots of folks who are wondering exactly how deep this investigation goes, if it targets Trump directly, and if that could have an impact on both his potential run in 2024, as well as how voters generally see the Republicans and the Republican Party. So depending what is in that affidavit, certainly we're not going to see everything. A lot of it's going to be redacted, but we're going to be looking very, very closely for exactly why the Department of Justice and the FBI had that really unprecedented search of Trump's Mar-a-Lago earlier this month.
All right, Emily Wilkins of Bloomberg Government, thank you so much with your reporting from Washington. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. I want to begin with a deal that maybe won't actually happen. Bloomberg reporting that Merck's deal for Seagen apparently is reaching some difficulty over price and as a result may not actually happen. As a result, Seagen is down about 7% in pre-market trading. Merck is not yet trading. There's also some earnings news out there, including Affirm, which is a payments company, giving a disappointing revenue forecast for 2023. The company talking about the macroeconomic environment and headwinds there. And as a result, that stock is sinking 13% before the bell. It is a more positive story, though, for Workday, which is that HR application software company. It beat expectations, although the bar was pretty low, but nonetheless, the share is still getting rewarded for it this morning. It's up about 11% in early hours, Anna.
Coming up on the program then, Kailey, we will be live from Jackson Hole. Yes, we know it is the middle of the night there, but we have a dedicated team. We will be joined by Julia Coronado, founder of MacroPolicy Perspectives and a former Fed economist. Fantastic voice for us to hear from today then, as a lot of the focus is on Jackson Hole. And later today, we will hear from a string of Fed officials, including Patrick Harker, James Bullard, Loretta Mester and Raphael Bostic, live from that symposium in Wyoming. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today. Of course, all eyes are on Jackson Hole, but I would argue a little bit more emphasis on the market reaction after that, specifically as we look at financial conditions. For our radio audience, stick with me. We're looking at a chart here of the Financial Conditions Index. And of course, you can see that as we go into kind of negative territory starting in March, really on the onset of the war in Ukraine, well, it has continued to go into negative territory, but it is still higher than when tightening first began. So what's important to note here is that on the one hand, it's a concern because it's saying, well, is the Federal Reserve's kind of moves when it comes to quantitative tightening and interest rate hikes really working in terms of pulling back on some of that stimulus in the economy? On the other hand, is it a sign that the markets are actually able to digest what the Federal Reserve is serving them on a silver platter? Let's ask Noor Al-Ali, Bloomberg Markets Live editor. She joins us now from London. We are thrilled to have her back on the show, by the way. Noor, thank you for joining us. Let me put that question to you. How big of a concern is it that financial conditions are looser as the Federal Reserve gets tighter and tighter?
Well, if you want the answers, you'll get them from Esther George. We've been hearing a lot of remarks from her recently. They've been recorded this week, and she clearly said they want financial conditions to tighten along the rate path in order for them to loosen up that tightening cycle. Obviously, the hawkish Fed speakers that we've had, from George to Bostic and Bullard, are paving the way for a very hawkish statement that's pretty much priced in later today from Powell.
Good morning to you, Noor. In terms of what we hear from Powell, there does seem to be certainly a lot of the preamble's been hawkish. We've heard a lot of hawkish commentary of late from the Fed very broadly. Is there room then for a dovish surprise?
Oh, yeah, absolutely. I mean, that's basically what we're primed for. You did see, though, yesterday, even as, that hawkish commentary was coming out of those Fed speakers, markets were pretty much unchanged, as though they fully priced in that hawkishness. However, there is room for that dovishness to fully surprise. But we do know historically that Jackson Hole is not really about that forward guidance. It's more about economic research. So it is about what the market is willing to interpret from the Fed and what Powell's saying rather than what Powell would say.
Okay, and you will be able to, of course, hear the man himself later on Bloomberg TV. Noor Al-Ali of Bloomberg Markets Live, thank you very much. And for more market analysis, check out Markets Live Go, MLIV Go. That is the function to use for the Markets Live blog on the terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Germany is considering restricting the companies able to benefit from a new gas levy to those that really need the help. The government has faced scrutiny following an outcry over soaring profits at some energy companies. Germany initiated the plan over concerns of failures of gas companies would trigger wide disruption in energy deliveries to Europe's biggest economy. A buyout group led by KKR has pulled its $14 billion all-cash bid for Ramsay Health Care. It comes a day after the operator of Australia's largest network of private hospitals said it would not further engage on an alternative cash and shares proposal. The Sydney-based company released a statement confirming a Bloomberg News report. It will work with KKR Group to see if it can improve its offer. Blackstone is the latest institutional investor to back away from an overheated housing market. Home Partners of America, the single-family landlord owned by Blackstone, says it will stop buying homes in 38 U.S. cities starting next month. The company cites home price growth, market demand, and increasing regulations as factors in its decision. Home Partners operates in more than 80 markets. And T-Mobile is teaming up with Elon Musk's SpaceX to offer wireless phone service in remote parts of the U.S. where coverage is spotty. Musk and T-Mobile CEO Mike Sievert announced the partnership at SpaceX's Starbase in Texas. Musk says the satellite-based service will work even during hurricanes and natural disasters. Coming up, we will beat the drum to Jackson Hole with Chairman Powell due at 10 a.m. Eastern Time. We'll get the take from Wyoming with Julia Coronado, founder of MacroPolicy Perspectives and a former Fed economist.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Countdown to Powell. The Fed chair will be under pressure to hit all the right notes in today's Jackson Hole speech, as some of his colleagues stress the need to move onwards and upwards with rates. UK regulator Ofgem triples the price of winter for many households with a hike in the domestic price cap, whilst warning more hikes will come. And Biden shifts into campaign mode. The U.S. president touts a string of legislative wins and urges voters at a rally in Maryland to protect those policies. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. And Kriti, we're still waiting for Jackson Hole. Today we hear from Jerome Powell.
Waiting with, I had to say it, not a ton of action, at least in the pre-markets when you're looking at it from a macro perspective. S&P futures, well, they're kind of where we left them about 30 minutes ago. You are seeing them trade on a little bit of a down note, though, down about 0.3%. And it's a similar story in the 10-year yield as well. 307 on the 10-year, yields up to the tune of about 5 basis points. The dollar really unchanged once again. Anna, I think when we're talking about some of these moves, there really are just perhaps retracements and reversals from some of the action that we saw yesterday in the market as well. The S&P 500 rallied 1.4%. Only natural to see a little bit of a pullback today. Similar story for yields. Yields came down quite a bit yesterday. Yields are reversing in the other direction today. So, Kailey, when we're talking about the macro picture, it doesn't seem like there's a ton of real direction, a ton of messaging, at least in the pre-market macro story.
Yeah, I'm sure it'll be a very different story 5 hours from now when Chairman Powell has wrapped up his speech, Kriti. I will say, while it seems pretty calm on the surface level, there is more movement happening beneath the surface of the equity market. A lot of movers out there in pre-market trading, including Dell, which reported after the bell yesterday. The quarter actually was pretty solid. Where the negativity is coming in is from the language from company executives themselves, talking about how customer behavior is getting more cautious, warning of potentially a softer environment going forward. And that is why the stock is down 4.3%. And it's dragging on shares of HP as well. They're down a little more than 2%. You also have some maybe not so much merger action. It is in fact actually Bloomberg reporting that deal talks have stalled between Merck and Seagen. It would have been Merck's biggest deal in about a decade with that cancer maker, but apparently there is a dispute over price at the moment, which is why those talks have stalled. So as a result, Seagen is down about 7%. We'll keep an eye on Merck once it begins trading in early hours, Anna.
I also have some M&A to talk about. More on that in just a moment. Kailey, we'll start with the big picture on markets then. The Stocks Europe 600 down by 0.3%, and that's despite the fact we've seen gas prices pulling back a little bit from their most recent highs. That has been something that's boosted risk appetite, but not so much today. And we're just waiting really for Jackson Hole, but a little bit more negative actually than we were just half an hour ago. A few stock-specific stories for you. Relex, the publisher over in the United States, some concerns about changes to the rules around federally funded research, and that's got some analysts concerned about the ability to monetize that. That stock down by 3.4%. And in fact, the media sector, the worst performing here in Europe. So keep an eye on that stateside. Sanofi in the drug space, some speculation about maybe levels of payout to do with their antacid medicines. Maybe they won't be as much as maybe some analysts had anticipated previously. This all to do with some tentative rulings made by a judge over in Florida. And Microfocus International, this is a FTSE 250 listed software business here in the UK. And this is the M&A I was talking about, Kailey, up by 93%, 92.5% as a Canadian bidder steps in for this company.
Massive move for that stock, Anna. But let's turn back to the broader macro picture because the annual Jackson Hole Symposium is underway in Wyoming and markets are bracing for a highly anticipated speech by Fed Chairman Jay Powell. For a bit of color and context surrounding the symposium and a glimpse at a cowboy hat, Bloomberg's Michael McKee filed this report.
The Fed Chair's speech is the main event on Friday. Thursday, the talk of the conference was liquidity, but not the Wall Street kind. A massive storm hit Grand Teton National Park, flooding the roads and blowing down the TV tents, and creating its own inverted yield curve. Jay Powell's speech may not have an impact on the markets quite as dramatic, as investors have already priced in a hawkish message. Even if he says nothing new, they will probably take it that way. Meanwhile, we've had requests for a sequel to our history lesson on how the Federal Reserve ended up here. How did Grand Teton become a national park? A higher power took care of the mountains, scientists think about 2.2 billion years ago. Fast forward to 1929, and a small portion of this area became a national park. And then came John D. Rockefeller. He was so enchanted with the area, he basically bought almost all the land between here and the town of Jackson. And in 1943, he donated 43,000 acres to add to the national park. Now, this is where the deer and the antelope play. Grand Teton and Yellowstone to the north are also home to bison and elk. And once a year, in late August, you can spot central bankers in the wild here in Grand Teton. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Another great report from Mike. Well, joining us now live from Jackson Hole, yes, at 3:30 in the morning, is Julia Coronado, founder of MacroPolicy Perspectives and a former Fed economist. So, Julia, many, many thanks to you for waking up at this hour to join us. Chairman Powell on the podium less than 5 hours from now. What are you expecting him to say?
Well, I think as Michael laid out, he's going to say a lot of the same thing he's been saying, which is that the job of restoring price stability is far from done, that they expect to be continuing to raise rates for a while, well into restrictive territory, where restrictive is means to them that rates are above long-run rates. So we're kind of at their long-run estimate of 2.5. But in an inflationary environment, that's not neutral. So they're going to keep going. I don't think he's going to give us a strong tell about what they're going to do in September. There's still data to get between now and then, very important data. And so I think he's just going to reiterate the same message. I think the theme of the conference, which is, revisiting constraints on policy and the economy, he may cite that, the Fed has been disappointed again and again on the supply side of the economy, and they have to be ready to calibrate accordingly. If the supply side doesn't improve, doesn't yield some of the relief that we've been expecting, then they'll have to keep going. But at the same time, I think the core message right now is data dependency. I think it's been a humbling year for the Fed. I don't think he's going to be pounding the table that he knows exactly where they're going. I think he says they're going to feel their way there.
But Julia, if he isn't very firm in saying that they know where they're going and that that's going in a hawkish direction, does that not just fuel potentially what we have seen in recent weeks and months, which is that financial conditions have actually gotten easier as the Fed has tightened? Why would he not need to push back aggressively against that?
Well, it's a great question, and he may in fact push back somewhat and stress that they have great confidence that the direction of travel is higher rates, which I do think they do have that confidence. So we may get a little bit of that. But, if you look at the rate path that's priced into markets, it's not that out of line with the Fed's own sort of baseline rate path. And what we're going to see very likely if the higher rates start taking a toll is that we're going to see the flow of economic data, the flow of profits. You were just citing some profit warnings. That's going to tighten financial conditions in addition to the rate path itself. So, earlier on in the year when the Fed was at 0 and we hadn't started QT, they really had to pound the table to get that message into financial conditions. Now we've got tighter policy. We've got a housing market with home sales down, 30% on the year. We've got some signs that the tightening is taking in effect. Their data dependence means you're going to follow the data. And I think one of the lessons of last year is if the data are, in fact, continue to be inflationary, then absolutely they're going to go where they need to go to address that. At the same time, if the global economy is in free fall, they'll respond to that too. So, how the market is going to take that message and how hard he pounds the table on the bias towards raising rates sooner rather than later, we'll find out in a few hours. I think he's been saying the same thing, and yet markets have sort of pivoted. He hasn't pivoted, markets have pivoted. So we'll see what he does with that.
Well, part of that pivot, Julia, is also the fact that perhaps they're able to digest some of these market hikes at a time when I think a lot of investors particularly are worried about liquidity and are worried about market plumbing. I'm curious if the Federal Reserve should even be concerned about the liquidity story, or is this kind of to some extent interpreted as, well, we can give the markets perhaps a little bit more of a tougher stance because they can handle it?
Yeah, I mean, there are liquidity issues. None of them have been acute so far, but I think the Fed is aware of those. And I think the fact that they're doing QT at the same time as raising interest rates adds a dimension of uncertainty to how far they'll have to go and how this will play out, because balance sheet policy and liquidity can often be very nonlinear. And actually, President George cited that yesterday, that, she actually seems to prefer to move forward at a 50 basis point pace because they're doing QT and because those impacts can come in rather suddenly. And that's a dimension of tightening through global markets. And I think it's really important also to note that the easing in financial conditions has been mostly a U.S. phenomenon. Global financial conditions aren't easing in the same extent, and global economic indicators are certainly weaker than the U.S. And while the Fed is, focused on the U.S., that does matter as well. Some of the easing in U.S. relative to global financial conditions can sometimes be almost a flight to safety. When the environment is very uncertain, people hold dollar assets, and the U.S. economy has been the outperformer. So, I think that Chair Powell and the FOMC have to bring all of that to the table when they make the decision in September.
Julia, I'm so glad you brought in that international perspective, because this week alone, we've also heard a lot more stimulus coming out of China, and at the same time, perhaps a little bit more of a hawkish stance on the ECB, just as they perhaps face a recession coming into at the end of the year. I'm curious about that policy divergence, though, between the United States and China. Is that something economists should be worried about when it comes to the global economy?
Yeah, I think we've been seeing some very significant moves in currency. Those are things that can add to that kind of global illiquidity, depending on how these central banks, balance against each other. So I don't think that that's the primary determinant of policy, but I do think, again, that it is on the table for discussion as an element of the environment. The global economy is slowing in a very pronounced fashion. Other central bankers are doing some of the work, as you noted, in Europe. And the European trade-offs are far worse than what the Fed faces. Even though U.S. inflation is higher, the U.S. economy is a lot more resilient. The Fed can have confidence, kind of marching forward with higher rates with the job market that we've got. The trade-offs are slightly better, although nobody is facing good trade-offs, not China, not Europe, not the U.S.
Yeah, difficult situations globally, but for different reasons. Julia, do you think that we will get any reflections from the Fed about how far we've traveled in our understanding of inflation and what has been wrong in the Fed and other central banks' assessments of where inflation has been? Because you mentioned in your notes ahead of our conversation that it was Jackson Hole last year where Jerome Powell set out 5 reasons why he expected inflation to moderate. Do you think we need to reflect on that?
Yep. Yeah, absolutely. And look, Chair Powell is a man that is reflective, and he's very forthcoming about that. So I think he will say, we need to be humble, and we need to, follow the data where it goes. And which is why I don't expect him necessarily to pound the table that he knows exactly where we're going, other than to say, you can trust us. We're going to restore price stability, even if it comes with economic pain. And remember, we don't get Q&A with Chair Powell, so we won't get to press the nuances of the speech. But I do think there will be a lot of elements of humility that, again, to the conference theme of constraints, the global economy is operating under even, a lot of constraints that we didn't expect to last, and they've lasted. And that's certainly salient information for the central bank targeting inflation.
We talked about China and the risks there. We've also mentioned in passing some of the challenges that Europe faces, Julia. I know this is a US event, and as you've pointed out, the policy focus is going to be on the United States. But how concerned do you think the economic community that's gathered there, how concerned are they going to be about the European growth story over the winter and all the energy challenges that it faces?
I can tell you there's a lot of conversations about Europe here, and there are a lot of European policymakers, and we've got a couple of panels. Chair Powell is the main event, but remember, there's a couple of panels with European ECB policymakers today and tomorrow. So we may get some, information from the European side and from the European policymakers here as well. And I think Europe is very much in focus as the epicenter of both economic weakness and, inflationary pressures that are coming from the war situation that aren't going to abate anytime soon, and it's going to be a tough winter for Europe.
Julia, thank you very much for your time. We appreciate it, especially as it is so early there in Jackson Hole. Julia Coronado of MacroPolicy Perspectives, thank you so much for joining us. And indeed, as she was pointing out, there will be some European voices speaking over the weekend. We set our clocks for early FX trade in Australia then perhaps on Monday morning. Coming up on the programme, we will talk to Antoine Bouvet, Senior Rate Strategist at ING. What will Antoine be watching for today? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with World Bank President David Malpass. That's it, live from Jackson Hole at 8:45 a.m. New York time. This is Bloomberg.
So I think what you're going to see is more strength in the real economy than in the financial economy. The financial economy converged to the real economy, and that's a big move in financial assets, a big downward move in financial assets in total. To some extent, that'll be in bond markets. To some extent, that'll be in the equity market. But in aggregate, let's say asset markets declining at something like the 20-25% decline from here.
That was Greg Jensen, Co-Chief Investments Officer at Bridgewater Associates, speaking with Bloomberg yesterday, speaking with Kailey Leinz, I think. Joining us now is Antoine Bouvet, Senior Rate Strategist at ING. Antoine, very nice to speak to you. So we're preparing for Jackson Hole, of course, but he was talking there, Greg Jensen was talking about the effect of QT, and our last guest was actually talking about how QT adds uncertainty to this rate hiking cycle. Is that something we need to keep in mind as we brace to hear Powell later on? Is it going to be something that he returns to?
I don't think this is something necessarily going to return to, but we should pay attention to it. Ultimately, quantitative tightening in that magnitude is something unprecedented, and even the Fed doesn't know how it's going to play out and how it's going to interact with hikes. So that's one more reason for them to be a bit more cautious than if this wasn't happening.
Do you think we will be any the wiser by Monday, Antoine, about whether we see a Fed that hikes and then cuts or hikes and then holds?
Well, I think at the margin of Jackson Hole, we've heard a lot already from various speakers, and what they told us.
Hawkish warm-up acts.
Exactly, yeah. So first off, I don't think there's a lot more than Powell can say on this sort of micromanagement of the curve. Secondly, I thought the Fed was supposed to have given up on forward guidance, and here they are giving us, ideas of what interest rates are going to be 1 year down the line. That Fed is backward-looking. They're basing their decisions on realized inflation. It's completely rational for them to tell us, financial conditions don't ease, rates will go up, and so on and so forth. But that doesn't say anything about the decisions they will take 1 year down the line, which is exactly what the curve is pricing. So, I think they've had some effects on the curve. Rates have risen. There is not a whole lot they can say to push rates up. But one of these things could be a direct reference to financial conditions. I think the market will take that as another hawkish barb. Another one would be perhaps a bit dramatic, but a hint that inflation dynamics have changed and that the Fed needs to act more forcefully.
Okay.
Antoine, I take your point about forward guidance. It's almost like it died, but then was immediately reborn, just maybe in a different form. You just said there that there's not going to be much that can push rates higher from here that the Fed could say. Do you think we've already seen the peak at the short end?
At the short end, not necessarily. At the back end, yes, 3.5% 10-year treasuries. I think the peak is in, and I would be surprised if we test it. Now, it's not really far. The thing I would say, though, is I wouldn't really overstate the importance of Powell's speech in the direction of treasuries. I think the jobs report next week and the CPI the following week is really what's going to dictate performance in treasuries over the next few weeks.
Yeah, there's a lot of data between now and when they actually make their next rate decision on September 21st. So that's a very fair point. You said we're maybe not done at the short end, even if we've already seen the peak in the long end. How much deeper do you think curve inversion can go?
Through 50 basis points, if you look at the two-stance treasuries. It will depend a lot on how quickly the recession fears, especially in Europe, hit home. Ultimately, this is something that's going to put demand back towards the back end of the curve. This is also what's going to help the market realize that ultimately, perhaps not in 2023, but in 2024, will allow the Fed to cut rates, and this is going to be beneficial for treasuries. So that inversion could go through 50 basis points. I think so.
Antoine, what is the Treasury market really being driven by? I mean, obviously the answer is the Federal Reserve naturally, but I'm curious in terms of the cross-asset correlations here, what are they actually perhaps leading and lagging?
Yeah, I think you're making a very good point, actually. We should put the jump of in US Treasuries above 3% in the context of, very sizable rebound in the stock market and this environment. Investors think, well, perhaps we've seen the worst in terms of tightening. Let's pile in risk assets rather than US Treasuries. So if we see another correction in risk assets, especially in the stock market, due to the realization that we're heading into recession, that this is going to be negative for risk assets, then this is what's going to drive Treasuries back lower. So more of a lagging indicator, I would think, in that case.
A lagging indicator, but then again, I'm curious about the bull case for Treasuries. It kind of felt like, as we were talking about a very hawkish Federal Reserve, the bull case for Treasuries that has, I want to say, been driving the market for the last 10 years seemed to kind of collapse. But as Kailey says, perhaps reborn again in another form. How quickly does that bull case for Treasuries become the base case for a lot of investors as we talk about recessions in other parts of the world?
Quite frankly, I think it's going to be closer to the end of the year. So we have a forecast of 2% for 10-year Treasuries around in the first half of 2023. That bull case centers around inflation falling back towards target, and it's clearly not going to be back at 2% in the middle of 2023, but it will be on its way there. And remember that some components of CPI, the housing ones, are led by house prices effectively, and the housing market is falling off a cliff. Fast forward to the middle of 2023, inflation will be much closer to target, but not at target. But crucially, the Fed will be in a position to forecast inflation going back to target, and this is what will allow them to cut.
Can I pivot to Europe, Antoine, in our conversation? And in terms of European bond markets, how do you think we should prepare for fiscal announcements and fiscal generosity from European governments? Because there's a lot of talk of it, even where we haven't seen the detail. You kind of expect that is maybe coming over the winter. Is this something that bond markets would welcome because it secures European economies to some extent? Or will this just be something that worries bond markets because of debt levels?
I don't think this is debt level, strictly speaking, that does worry them. I think one of the fears, and we've seen that in the gilt market recently, is the interplay between fiscal and monetary policy. We've had some warning by the Bank of England, for example, that too generous fiscal package to support households would force them to hike rates more. So calibrating this fiscal policy will be very important. Yes, you're right, there will be more debt issuance, and in the short term, in a market that is illiquid and very nervous, this can have a short-term impact. But more profoundly, what will the Bank of England do, and what would the ECB do when they see these fiscal support packages? My view is they should be relatively generous to shield the most, let's say, vulnerable households. But this is not enough to shift my expectations on monetary policy.
So it has to be quite targeted?
Yes.
Yeah, okay.
Well, of course, we talk about monetary policy in the UK and Europe, and there's a question of whether or not anything they do, even if it is aggressive rate hiking, can actually support the pound or the euro. It just seems to be that it is dollar strength, full stop, for the time being. Antoine, how does that feed back through to the rates market for you?
So it's a problem, clearly, especially in the UK, imported inflation, and so the weakness of cable is a problem. But also in the Eurozone, the weakness of the euro means higher import prices. I share your view. I don't think central banks, there's a lot central banks can do. Ultimately, of course, pushing the reasoning to an extreme, they could if they put rates to very extreme levels, but to levels that aren't realistic. So for now, dollar strength and weaknesses in European currencies, unfortunately, the reality.
Antoine, thank you very much. Thanks for your time. Good to speak to you. Antoine Bouvet of ING joining us to help set us up then, Kailey, for Jackson Hole and what we hear from Jerome Powell. I thought it was really interesting, though, how we were just talking there about guidance and about how forward guidance had supposedly gone and it wasn't useful, very data dependent now, central banks around the world, not just hearing that from the Fed, of course, Kailey, but elsewhere. Maybe it's the media's fault. Maybe we keep asking them too many questions.
Yeah, you could probably blame a lot of things on us, Anna, but I think markets really will be looking for something in the form of guidance. And Creedy was talking about earlier how the market is expecting hawkishness. We have seen that being priced in leading up to this. So what exactly is Chairman Powell going to deliver at 10 a.m. Eastern? Can he take this market by surprise?
Yeah, absolutely. Right, later today, we will hear from a string of Fed officials, including Patrick Harker, James Bullard, Loretta Mester, and Raphael Bostic. All of that live from Jackson Hole. Also, of course, Fed Chair Jerome Powell speaks in Jackson Hole at 10 a.m. New York time, 3 p.m. in London. Stay with us for full coverage of Powell's speech. This is Bloomberg.